You build a quantitative trading strategy. You run it across 5 years of historical data. The equity curve trends upward in a perfect glowing line. Then, reality hits, and the model shatters on a liquidity gap it never saw coming. The problem is that recorded financial history is just a single path, one specific realization of reality. Truly catastrophic, model-breaking events are statistically rare, meaning they barely show up in your training datasets. Because those extreme samples are scarce, your algorithm over-optimizes for ordinary trading days. When the market regime shifts, the underlying distribution of returns drifts away from the center, leaving your model operating blindly in the unsupported edges. A strategy that executes flawlessly during a decade of low interest rates has no mathematical reference point for volatility clustering or cascading cross-asset contagion. It hasn't learned to survive those conditions.
Optimizing strictly against past events trains your algorithm to survive one lucky historical sequence. It guarantees the model works on the crises we already had, rather than preparing it for the full spectrum of market risks. When a strategy fails a stress test, the standard industry reflex is to manually patch the vulnerability by rewriting the trading logic. Finterra approaches this differently. Instead of altering your code to dodge a specific risk, you alter the data infrastructure underneath it. The objective is to expand the tail state space. By injecting statistically valid, unencountered extreme scenarios into historical datasets, you expose your model to severe turbulence before it goes live. This operates as a strict, non-intrusive protocol. You input standard price histories, and the system outputs synthetic heavy tail variations, formatted as PTOHLCV, that plug directly into your existing backtesting framework. Moving stress testing down to the data layer allows quantitative researchers to objectively measure resilience without the risk of accidentally introducing new bugs into the core execution logic. Before any synthetic stress scenarios can be generated, the system requires an absolutely rigid, clean historical bedrock. This bar chart displays the evaluation universe required to build that foundation. It covers 16,979 assets across 5 distinct markets: A-shares, U.S. equities, Hong Kong stocks, crypto, and foreign exchange, totaling 13.56 million rows of data. Every single asset runs through strict standardization protocols. The date, open, high, low, close, and volume fields are forced into a unified format. Next, the pipeline applies deduplication and processes corporate actions like stock splits and dividends. Failing to adjust for these events would cause artificial price jumps, polluting the volatility calculations. To handle missing values or non-positive quotes, Finterra uses a source fallback architecture. If a primary feed like Tencent drops a packet, a secondary source like Yahoo Finance instantly steps in to patch the gap. Throughout this processing, the system explicitly preserves both the raw original prices alongside the adjusted figures, creating a perfect audit trail for compliance teams. Without this obsessive data hygiene, any extreme synthetic event generated later would be dismissed by quantitative researchers as a mere data error rather than a mathematically valid stress test. This process graphic maps out the non-parametric pipeline used to generate the synthetic stress data. It relies on a 5-step mechanical transformation. Step 1 is feature extraction. We read the standardized historical data and break the candlestick down into mathematical vectors, isolating the absolute returns and rolling volatility. In step 2, the pipeline stratifies those returns into 3 distinct zones based on their distribution: normal, transition, and long-tail states. By separating these states, we leave standard trading days relatively untouched. You cannot simply apply blind, noisy mathematical perturbations across the entire dataset without destroying the market's natural structure. Step 3 generates the actual stress mechanics. The system draws samples from an exponential heavy tail prior distribution. To keep this synthetic data tethered to reality, we match the rank of that abstract exponential distribution directly to the intensity of actual historical market events. In step 4, we construct the candidate returns. The targeted tail regions undergo specific amplification, smoothing, or defensive blending. Crucially, this manipulation strictly preserves the original causal sequence of the time series. Retaining time order prevents look-ahead bias from infecting the final dataset. Finally, step 5 is reconstruction. We translate these synthetic return vectors back into complete price paths, forming the new heavy tail candlestick.
This rebuilding phase operates under absolute mechanical constraints. The synthetic high must always be mathematically greater than or equal to both the open and the close, and the low must remain at the bottom. Enforcing these internal candlestick boundaries is critical. It separates a mathematically valid stress test from impossible garbage data that a trading engine would immediately reject. Having built a statistically rigorous pipeline, the challenge becomes deploying it securely at an institutional scale. This deployment diagram illustrates Finterra's split server infrastructure. It physically separates the application server, hosted in Singapore, from the private model calculation layer, located in London. The public-facing application layer handles the standard front-end interactions. It manages the React interface, API keys, and basic access control. Meanwhile, the private computing layer is entirely isolated. This is where the heavy-tail Python workers and the TimesFM prediction engines actually execute the transformations. The core security mandate here is absolute separation. A client's raw, proprietary market data and internal parameters never leave that private computational domain. To further guarantee isolation, the API architecture is designed to delete all temporary execution files immediately after a calculation finishes, eliminating any chance of cross-contamination. By decoupling the public presentation interface from the mathematical engine, quantitative funds can safely ingest advanced synthetic data without ever exposing their proprietary alpha. The underlying theory is sound, but it demands an empirical test. Does training a model on artificially expanded tails produce better out-of-sample forecasting? This table shows a fixed origin A/B test using the frozen TimesFM engine against unobserved future returns. The massive scale processed 33,958 paired inputs into 679,000 prediction points without failure. Synthetic heavy tail data drove a 1.87 Sharpe ratio increase and pushed win rates up 5%. Because the prediction engine itself was entirely frozen during this test, those gains isolate the impact of the data layer. It proves the synthetic inputs inject a generalizable, structural signal into the model, rather than just random noise. Despite these results, it is critical to understand the boundaries of this tool. Generating a synthetic heavy tail is not a crystal ball for predicting exactly when or where the next global market crash will hit. This coverage chart illustrates success in evaluating future risk scenarios. Relying on a single historical path encompassed maximum future daily volatility only 93.5% of the time. Generating 4 synthetic stress paths pushed coverage to 98.9%, a 3.77 times expansion of tail state space. Ultimately, this infrastructure acts as an algorithmic flight simulator. It does not execute your trades or predict the weather. It strictly ensures your model has survived the worst statistical turbulence mathematically possible, long before you ever trust it with real capital.